As always, we kick off looking at motor fuels. So again, it's just looking at gasoline, distillate, residual, jet fuel. Just looking at what are those mobility fuels doing. We had been saying that when we started off the year, we thought that we were going to average, something just below or about at 15 million barrels a day. Last week, we were at 14.57. This week, we're at 14.9. And you can see that we're still trending below where we were in 2022, 2021, 2019, 2018, 2017. It's just we're not getting to that point, and it's not surprising just because you've had a big increase in prices for gasoline and diesel. We don't have driving to the same degree that we've had in previous years. We don't have the trucking that helped save us in 2021. As you can see, 2021 continued to grind higher. That was not because people were driving more. They weren't locked in like in 2020. But it was a lot of that was driven by trucking, and that is something that is just not coming back to the same degree. And we're going to show that in a bit more detail. So then when we look at distillate had a draw of 1.71 million. That's 23.2 million below the 5-year. When you look at pad 1, that's 16.3 million below the 5-year. When you look at the fact that we had another draw from distillate, we actually exported 2 shipments from pad 1 into Europe. So it's just essentially saying that it makes sense to send to Europe, even though we continue to be at this low end, which again, more support for how tight the distillate market is, how tight the diesel market is, gas oil, whichever area you're in, you're going to call it something different. But it's just there is a lot of tightness, which is why we've seen Russia increase exports. We've seen China increase exports. We've seen Saudi increase exports of refined products to take advantage of this as we fall back into a no man's land. Imports were down 47,000 barrels a day. That's a drop of 119,000 barrels a day, which again, we sent 2 shipments to Europe. So we're not going to import it if we're going to be exporting it, especially given how expensive it is on the market. You're going to compete against the highest price market. And right now it is Europe. There's a fear about refilling, which was why we're seeing that more of that go over there. And there's also the disconnect between pad 3 and pad 1, where pad 3 is a bit more balanced, as is pad 2. So when you look at the data itself, it's really pad 1 that is causing the lion's share of the pain, given where we sit in the underlying market. And the crack spreads are supportive. Crack spreads, we did not think that the crack spreads were going to have this kind of rally. We also weren't expecting Saudi to do a voluntary cut when we first made the call about that continuous move down. So what happens? You make those crudes more expensive. Refiners have to pass through those costs. So they're going to increase. They're going to try to pass through those cost increases because of the tightness in the storage market. They're able to do so. So the crack spreads are going up. Even though costs have gone up, you're still seeing all the more reason why you would try to make as much diesel as possible. Pad 1 continues to be at a very low level. We're better than 2022, but again, very low. Last year, we were saved by a warm winter. If we just have a normal winter, this can get very ugly very quickly, especially because the Atlantic Basin is going to see prices go back up, and you're going to see a lot of these underlying problems that are going to continue to fester. Pad 3 is just managing their storage. They're fairly comfortable. They're just above where they were last year. They're going to play the game of what can we import? What can we create? Does it make sense to go into Colonial? Does it make sense to go into the Atlantic Basin? And this is going to be the back and forth at this point in time, and they're going to be able to manage that fairly well. Then when we look at products supplied, for diesel, as we were saying, it's going to be below the 5-year average. It's going to live within that lower end of the cloud, so not too much has changed in general. When we look at the trucking side, as you can see here, a little bit of a bounce, and as we've said on the Econ show, you can only run so low for so long. You still need equipment, you still need supplies, you still need stuff in stores. So again, you're getting to that balancing point, and now we're going to continue to go sideways a bit. When you look at rail data has gotten a bit worse. Total carloads are down 1%. A lot of that is driven based on the comparisons to last year on forest product grains, motor vehicle and parts, metal ores, the petroleum products continue to be strong. Intermodal continues to weaken, was down 5.2%. Intermodal, again, back to what we've been saying with the pressure points that we continue to see on the consumer, on just the inventory levels, is going to keep intermodal low. This was interesting because it's just looking at the 6-week moving average. Rail traffic is down sharply year on year and down below where we were in 2021 and 2022. But it is improving a bit. So one of the things that we've been saying is, things were so low for so long. You still have back to school. You still have Christmas. So you still have a certain amount of things that you're going to move. Our view is that people are taking advantage of some of the cheaper pricing on rates. Obviously, diesel has come up again, so that is offsetting a bit and trying to get some of these products to where they need to be ahead of schedule. Because when you look back through the system, there's nothing in the water that is showing that there's a big increase. Masterec actually took down their estimates again for global exports. We continue to see more pressure on the export side. And just what's in the water, that's something that has been reiterated from what we've been seeing coming from Fujairah, from Singapore, some key bunker fuel hubs. You're seeing that play out, and here's just more pressure, or showing some of the similar. Natural gas has had a nice little rally back to $3. A lot of that is just based on some of the rampant heat waves that have been hitting and continue to hit the south of the country. Things get a bit warmer into New England. So whenever that happens, typically you have a nicer, or I should say stronger rally in natural gas. The running joke is that when NYMEX, which is downtown Manhattan, if they have to put a coat on to go get lunch in the winter, gas goes up regardless of what is happening around. And then if they sweat going to get lunch in the summer, gas will go up. So again, just a running joke that is amongst, for anybody that trades or has traded natural gas, that is a commentary where you'll get some of those strong rallies post lunchtime. Things have cooled off a bit in the north. Again, it's just things are getting a little bit warmer. It's not a huge move. We don't see this rally in gas as really sustainable at this point, especially as there's a bit more pressure coming into August when you look at some of the cooling in the Northeast. But again, it's just where we are right now. Now we pivot to gasoline. Gasoline had a draw of 2.66 million barrels. That took us down 16.8 million below the 5-year. When you look at it, it's a pretty balanced draw. We're higher than we were in year on year in Pad 1, but as when you look at Pad 1, Pad 2, Pad 3, or why we have a little bit of this, essentially hugging that 29-year average. We just see it again, as we've been saying. We thought it was going to go higher and then go sideways. Instead, we've just kind of held this line. Gasoline imports fell 261,000 barrels a day. That's 165,000 below the 5-year. But it was really driven by Pad 1, which dropped 246,000 barrels a day. A lot of that is timing. We do see that bouncing back up just because there is a significant amount that is still I shouldn't say significant, a larger amount than normal still in the water coming from Europe into the U.S. just because the U.S. pricing is much stronger than it is in Europe. It makes sense to get this into the U.S. European gas natural gas jumped the most since March of 2020 on LNG strike votes. Workers at the Australia LNG facilities vote for industrial action. So there's a concern about the LNG market and where some of those things are, which again is driving up some of the underlying prices. But when you look at it, then when we look at blending components were down 1.38 million. Finished motor gasoline was down, but ethanol was up. So if you start looking at some of the blending components, a lot of this is trying to get some of this out ahead of the switch back to winter grade, just because this is a higher value product, or I should say cost more, so you charge more. But gasoline prices continue to go up just based on where we sit in the market. When you start looking at where things are on the refiners trying to pass through some of those cost increases. Blending components sitting just below 2022 and that 10-year average. Obviously, you can see that in 13 and 14, they're much lower. One of the things that we've been saying is we're going to go a bit sideways. There's not a lot of petchem demand. The shortage in petchem demand is going to keep a lot of this in the blending pool for gasoline. When we look at data for the several locations, Asia Pacific, again, just is kind of hanging out about 10% below normal. It's right where it was in 2022. We don't see too much of a shift. Europe is the surprise. We thought Europe was going to stay a bit stronger. Instead, it's down 69%. It's versus July of 2019. It's down 69%. It's at a 69% level, so it's down 30%, 31%. Apology. So that was a big surprise. We did not expect that. The U.S. has seen a little bit of a slowdown. North America is 84.3% versus where it was in August 5th. That is a pretty sizable down move. We do see some of that coming back. We thought it was going to stay at that, it was going to go down for July, come back up, and then go sideways. And here you can see that it continues to drift a bit lower, which this is not going to help. As you can see, a continuous increase in pricing for both diesel and gasoline. That is just going to squeeze people further. As we've been saying, this is going to be a big tailwind for inflation when you look at July. And then as we continue into August, a lot of the estimates for inflation is creeping higher on the headline number because this is flexible inflation. We've also seen a pivot back up on the housing front side or the rent side. So even though we still have some of that sticky CPI to come down, it actually starts to pivot back up, which is not what the Fed wants to see. So that's what we keep talking about on why we see rates staying elevated longer, which is going to increase credit card rates, which is going to increase credit card balances, which will keep the rates going up. And again, it continues to compound. Now, here, when you look at the gasoline increases, here's where we look at some of the different levels. You can see that we're still below that 10-year average. We're tracking closer to where we were in 2022. We don't see it getting back to the average. We thought we'd get to about 9.4. Now we're kind of past that point. Just because additional schools started, you have more of that slowdown in terms of just underlying activity. So we do see a small drop down, not huge. Right now you have EIA at about 9.3. We're probably 9.1, 9.2. So we will get a small drop, not a huge one, but it's just kind of that stabilization at these levels. Now, when we look at propylene, here you can see a build of 1.33 million. We're 17.7 over the 5-year. We're 24 million over the year-over-year, still setting those records. So we don't see that changing given the backdrop in the petrochemical world. Jet had a small build of 140,000 barrels. When you look at the 5-year, right in line. When you look at the data for demand, we're at 1.81. So we thought we were going to have a bit of a drop. Instead, we had a bit of a bounce. We do see a sizable correction coming. And by correction, I just mean it going from 1.8 to probably 1.5. So a drop of about 250,000 to 300,000, kind of back into that range. And a lot of that is just coming based on, the week ahead passenger side. You can see that there's some stabilization. There's not too much movement one way or the other. Eastern Europe came down slightly. Asia is holding pretty firm. Western Europe coming down just a touch. But again, a lot of that is seasonal, so not too much of an adjustment. The bigger issue is the revisions from canceled flights. So you saw the revisions on July 26th, again on August 2nd. And that is going to keep, because you pre-order this, so then it sits in storage. So that will also account for some of the slowdowns because you've had a sizable drop in that jet fuel demand of about 250,000 barrels, which again is back to what we were saying in terms of some of the reductions. TSA passengers, I love seasonality, especially when you look at 2019 versus 23 in the U.S. They're almost one for one. The European area continuing to remain below 2019, but above 22, which is, again, right in line with our expectations. Not too much has pivoted there. Eating out is getting a bit worse. It's getting a bit worse in the U.S. Before we were kind of down 1 to 3%. Now we're down 3 to 4%, increasing to 7%. Globally speaking, it's getting a bit worse. The comps are getting harder. Costs are going up. We actually had to pivot back up in food prices, which is what we've been talking about, and that's going to continue to put pressure there. So again, demand isn't great. It's not that it's imploding, but as we've been saying, demand is not strong. When you look at crude pricing, when you look at some of these things, it's a level of fear. It's a level of impact when you look at some of these underlying areas where supply, you have Saudi that took 1 million barrels a day additional out of the market in August and September. You have Russia, which Ukrainian drones attacked a Russian tanker, so there's a lot of fear around supply. So that is, again, the supply side is the biggest driver here, because demand continues to be low. If demand was strong or back where we were in 2019, we'd already be over $100 a barrel. You have to kind of consider where would we be if Saudi didn't cut. And that's why it's more of the supply side and less about demand, as we continue to see here. So that's where we have here on the U.S. front. In the next segment, we're going to go deeper into OSPs, increases there, and some of the issues that we continue to see on the oil versus refined product side.